All right, so real quick, I'm going to show you guys how to trade options. So the play on this is basically that we are right now in 2021. Commodities are super cheap. Equities, stocks, tech stocks, the FANGs, Bitcoin, consider one of those, Tesla, all these other guys. Those are expensive. You look at their price to earnings ratio, which is how expensive the stock is relative to how much it pays as far as dividends go. They're way overpriced. There's a lot of speculation. This is pretty common. Um, this happens, when people have a lot of money to spend, when interest rates are low. If you look at the historical chart, somebody, a guy I knew who has been trading stocks for like 20, 30 years, told me that this was the one chart. If he had begun investing now 30 years ago, this is the one chart he would have followed, and he would have basically made millions. And he has made a lot of money now that he knows this is the right chart. But if you look back in 1999, that was when the tech bubble collapsed. So a lot of equity stocks like Enron and other big named tech stocks lost 90, 95% of their value because everyone was investing in these tech startups, and later realizing that these startups were burning more cash than they were actually bringing in. So there was a lot of news headlines that eventually came out about it. The yield curve inverted. Treasury bonds went to 10-year bonds, dropped down below 1-year bonds. That's a pretty common signal of an incoming recession. Um, and so everybody lost a crap ton of money. And after that bottomed out, commodities started going up from the period of 99 through 2008. And interest rates started going up as well. In 2008, we had the collapse, the Wall Street, the mortgage crisis, and commodity prices then went down, and everyone started investing back in equities and stocks, and that's where we are here in 2020. So um, uh, this is in the grand scheme of things. That's basically where we are. Um, a lot of these commodity companies like steel, metals, marine freight companies, energy companies have not done as well over the period of 2008 through 2020 because people have not been investing in them. But if you look at a steel company called ArcelorMittal, which is the world's largest steel producer, stocks were extremely cheap in 2001, right around $10 a share, and they went up above $200 a share by 2008 at the peak of the boom. So that's a 20. If you had invested in 2001, you would have gotten a 20-fold increase in your money in 2008 just based on the change in the stock price itself. What we see now is due to COVID, a lot of the mills have been operating at very much reduced capacity. That goes for a lot of ports as well. So ports off the coast of California, Washington, Oregon, all those blue states that have very strict COVID regulations. They can't unload nearly as many boats as they can otherwise. So ships are basically waiting out at sea for over a month. The whole supply chain is basically all but broken. Steel is at an all-time low because the supply is at an all-time low because factories haven't been able to produce as much of it, but demand is pretty much the same as it's been over the past few years and increasing. So China is going to a net steel importing country. They used to be a net steel exporting country. They're going to be importing about 19 million tons of recycled scrap steel over the next year. They've got a crazy amount of infrastructure spending, and they just got rid of their tariffs. So they're going to be basically driving up all steel prices significantly over the next year. Steel prices as a whole have been going up about 15% month over month. for the past 2 or 3 months, and are expected to continue at their current rate. They're up about 10% since last week alone. So if they keep it up, countries like India, which are huge steel exporters, are going to start placing tariffs on exports, and they're also going to regulate the amount that's being exported in order to so that they can use it in their own country for their own infrastructure projects. If and when that happens, it's going to further drive up the cost of steel. And so at some point, it's expected that the United States may also put price controls on it. Thankfully, companies like MT are international companies, so they're well suited to profit significantly from all this. They're starting up companies, they're starting up plants that had been shut down for a long time because they're going to need to they're going to try to meet the demand for steel. And at the old steel prices, these facilities weren't profitable. Now, over the next few years, they will be. Okay. So we're basically hitting all-time high prices for steel that we haven't, or at least those ones we haven't seen since 2009. We're hitting on a daily basis. Big banks like Jefferies, Wells Fargo, Goldman Sachs are all very, very bullish. I think it's kind of interesting that there's not a whole lot of discussion about these stocks on Reddit and elsewhere, mostly about Tesla and other meme stocks, but the big name banks and the people inside the industry all know what's going on. And so this is the play that we basically want to capitalize on. I'll come back to Vail, but this is basically a mining company, another commodity that saw its price go up over time and has since gone down since 2008. All right, so real quick, one way you could capitalize on this play is if you were to just buy stocks. So MT is currently at about 24.5 as far as the share price, and it's been going up at a rate of about 20% a month. Let's just check that. 20 to 30% per month since November. So it was at 14, December 20, January 25. So it's about 20% increase. It's going to keep going up, probably more than that. So if we just assume it's going to go up 20% month over month, that means by February it's going to hit 30. Just take today's stock price, multiply it by 1.2, add 20%. For March it'll hit 35. April it's going to hit 42. May it'll hit 51, and June it'll hit $61 a share. So if we were to buy the stock now and then sell it in April, you would buy it at 24.5, sell it for 42. So you make about a 70% gain, which really isn't that bad for a 3-month period. Now, here's where you can really capitalize on increases in a share price, right? An option is basically a contract which allows you to purchase the stock at a certain expiration date at a future point in time for what's called a strike price. And that's the price that's agreed to in the contract. All right, so the way this works is if MT's stock goes up 20% month over month and it hits $42 a share in April, and I have an option that allows me to purchase it for a strike price of $26 a share, the way I estimate my profit is I look at the difference between the stock price during that month and the strike price, all right? So let's say that's $16 a share, all right? Each option is a contract to purchase 100 shares of the stock, all right? So my gross profit would be the difference between the future stock price in April minus the strike price of $26. That's $16 a share. times 100. Then I subtract the cost of the option itself, all right? But I just wanted, that's the general idea. That's the gist of the option. So the higher the stock price goes, if I put out a call option, the higher it goes above the strike price, the more money I make. The way that I estimate my profit is the same. The futures, whatever the future stock price that I think it will be, minus the strike price, times 100, because again, you're multiplying it by 100 shares, minus the cost of the option itself. And I can also calculate my return on investment as being my profit divided by the cost of the option. So you pay for the option up front, and that's taken out of your profit. So you spend that money. If for whatever reason the stock does go below your strike price on a call, then the option just expires worthless. So we're betting that the stock price is going to significantly exceed the strike price. All right, now the way you bet on this is in your platform. This is E-Trade, so I'll go to my trading website, and you should have it under Robinhood. I find it's easier to do this on a desktop than on an app. And by the way, these options will go up and go down, good days or bad days. You'll see returns of 10, it'll be down 25% one day, up 50% another day. That's just, you're making a bet that's about 3 months out. So you have to ignore how it behaves over the next week or two. There will be increases and changes in steel pricing that will cause the stock to go up. Stock will shoot up 20%. It'll trade sideways for a few days. Your percent will go down, and then the next week it'll go up again. So you can expect a lot of ups and downs, but on the whole, it's going to go up. So to purchase this stock, go over here to Power E-Trade. And it's going to be a little bit intimidating at first, but it's not that. After a while, you get the hang of it. So I'll type in my symbol, MT. I go over here to options, and then here are my expiration dates from left to right on the top. These are for options expiring on January 21st in 2 days. These are for ones expiring on January 29th, February 5th. And then now I have April 21st, all right? So that's my expiration. This is what I'm looking at. The way that I can buy an option is I go over here. First of all, the left side is calls. That means you're betting the stock is going to go up. The right side is puts. This means you're betting the stock is going to go down. The strike price is right here in the middle. These right here, the strike price is below the current value of the stock. So it's 20 to 24. Again, your stock's sitting about 24.1. Your strike price is 20. These are going to be way too expensive. You're not going to make any money because everyone's already betting that the stock's going to go up and the stock price is already above the strike price. Anyway, that doesn't really matter. What you want is you want calls that are in the money by about, let's just say 10 to 15%, just so we can start playing with the numbers. Click on this buy right here because we want to buy an option. It'll bring up this screen. You want to buy one option expiring in April at a strike price of 27. So if I go over here, I can enter it into my spreadsheet. $27 strike price expiring in April. I'm estimating that the price is going to go up to about $42 a share, for about 20% a month. The cost of the option, E-Trade is saying it's going to cost me $147.51. All right, so it will tell you how much this option is going to be. And then I calculate my profit, which again is the difference between the future stock price minus your strike price, multiply that by 100, minus the cost of the option. Okay. So the way I can calculate my ROI then, so that would be my profit. Okay, $1,400. My return on investment would be my estimated profit divided by the cost of the option. All right, so that's a 940% return. That's pretty much better than any stock play you can make that I can think of over a 3-month period, or at least ones that are predictable. We can also do this with other strike prices. So if I think it's going to go up above 29, I'll go over here. So 29 is a little bit riskier because your strike price, you're saying the stock is going to go past 29 rather than 27. A little bit more risk, but let's enter it into the spreadsheet and see what we find. One option expiring in April for MT, $29. This is going to cost me $100.51. Okay, went down $1 from about an hour ago. My profit would be $1,200 with an ROI of 1,200%. Pretty good. All right, so this play is more profitable than the strike price for 27, but it's a little bit riskier because the stock has farther to go past the stock price. But I'm betting that it's going to hit that or exceed it. Okay. Once I do want to buy that, I just go over here, click send. And TD Ameritrade and Robinhood, not exactly sure exactly how they work. Fidelity is the same, but they're all the options chains are pretty much set up the same way. So it should be pretty intuitive to figure that out. And I can always help you. So another one that we can do if we want to try another company. So not all companies you can buy options for. You can't buy options for like SHIP. You can buy options for other shipping companies that could be profitable. Vail, which is a big mining company. There's a huge spike in iron ore prices that happened last summer, and Vail should be able to capitalize on it. So Vail has gone up. November was $11 a share. In December, it was about 16. So 16 over 11. Just in 1 month, it went up 45%. Now it's right about 18. Okay, so 18 over 16. It's up about 13%. I think I estimated that on average, Vail, because China is importing a lot more iron ore and they're still dealing with low supplies of iron ore in Brazil because of the COVID issues, premiums on iron ore are very high and will continue to go up over time. So Vail, I think I estimated, is going to go up about 30% a month. So maybe a little bit faster than MT. Okay, but just as an example, we're thinking it's going to go up 30% a month through April. See how much options cost for Vail. By the way, MT is not on certain brokerages like Robinhood. I don't really know why, but it just got taken off for some reason. You should still be able to buy Vail. There's a bunch of other iron and steel companies you can buy to capitalize on this. But Vail, let's say we want to buy it for April at a strike price of 21. My expiration date, April, strike price is $21. Future price, we're saying that it's going to go from 21 to 40. And the cost of the option is going to be $74.51 with the commission. So my profit Again, I use this equation, estimate what that will be. My return on investment will be even greater because we're assuming a 30% month-over-month increase. So it would be about a 25-fold increase in whatever money, assuming that Vail keeps on going, all right, at about a 30% increase. At the end of the day, I think it's going to be somewhat of a compromise between MT and Vail. I think they'll go up at fairly similar rates overall. Vail maybe a little bit more because they're more invested in the mining, and there tends to be a little bit of a lag between increases in raw materials and ores versus increases in finished products, which I found out the hard way earlier this week. But I think overall these two are going to do very well, and I could see these. I'm bullish on these into April and into June, and regardless of whether you invest in these companies or not, options can be a pretty powerful way to multiply your earnings even more than you could just from buying or selling certain stocks. The last thing I'll say is once you buy an option, make sure you sell it before it expires, or else it'll be assigned. And what that means is the brokerage will debit your account for the 100 shares on that particular day, all right? So if it goes up to $40 a share, it'll multiply that times 100, 4,000, and then debit that amount from your account. So there are some horror stories of people thinking, oh, I'm going to cash in like crazy. This is going to be awesome. I'm going to make so much money, but they forget to sell it prior to the expiration. The option gets assigned, and then instead of them making massive gains on the play, they go back and check their account and they're like $20,000, $30,000 in the negative. So just make sure if you do options, make sure to sell them prior to expiration. And that's pretty much it. You have to just realize that options are way more volatile than stocks. So you have to realize that it's a 3-month play. You could do options into June. I think they'll do even better into June. You have to wait a bit longer for them, but they'll continue to gain over time. Just be used to and be aware of seeing your account go in the negative. 50% one day, could go up 100% the next day. Don't be too intimidated by that. As long as the steel prices keep going up at the same rate that they are, this is a pretty reliable play. And I'm personally banking on making about 10 to 15-fold returns on this over the next few months. So I think that's about it. And if you have any questions, just let me know.